Good morning, options traders. Steve Ganz here, and I want to share another trade concept in the Start to Finish series. This is an earnings trade around NVDA. So, as most of you know, NVDA is a high flying stock. It has exploded through the whole AI thing, and it is pulling back a little bit here at this point. And it has earnings after the bell tonight on February 21st. So, how might I, as a trader, look to maybe capitalize on a trade in NVIDIA? Well, one of the trades that I happen to like around earnings is a calendar trade. Calendars are a little more complex than many trades and not something you should just blindly go into in a live trade. This is certainly something that should be paper traded until you fully understand how calendars move. And I'll show you why in just a minute. But looking at technical analysis, my expectation is that if NVIDIA were to sell off after the announcement, we've got a fair amount of sideways support here where NVIDIA kind of chopped sideways in a range in the 630 to 600 range. And I would expect that if NVIDIA sold off, that there's likely going to be some support in this general range. So I'm looking at that as maybe my downside range. Now, all of this is just what I'll call odds, okay? I think the odds are that if it sells off hard, it would have some support here. Now, that doesn't mean, of course, that that is a firm thing. It can certainly break through that and come down to 575 or whatever. But under normal circumstances, there is a little bit of support here. So if it were to sell off, I think that's kind of where I would think it might start to stabilize. On the flip side, it could easily, it popped up last time here in a hard run from 633 to, almost 750. So that's a 100-point up run. Well, if we take 100 points up here from 700, we're up here at around 800. So I think that's certainly in the realm of possibility as well. So how do I design a trade that might, and I stress might here, and you'll see why in a second, encompass that range? Well, I like a calendar trade. Now, what a calendar trade does is it takes advantage of the volatility difference between our front strike option, this one that expires here this Friday, and a further out, the very next option in this case, which is March 1st. And how it takes advantage of that, this is really cool in OptionStrat that we can see this, is I can come down here and you see in most of the trades I model, we do not have this little button here that says average. Most trades just simply show a line for implied volatility. And here we can see implied volatility is 132%. When all of your options are at the same expiration, you won't have this button. But when you have options that expire at different times, as we have here, we can look at those two volatilities independently. We can see that the volatility here on the February 23rd expiration this Friday is 170%, and the volatility on the March 1 expiration is 94%. Considerably less, not quite half, but significantly less. Now, this phenomena, if you will, is called backwardation. Under normal circumstances, an option further out is going to have a higher volatility because there's more time involved and there's more unknowns that come with that extra time. So the price of the option can be impacted more, usually in a further dated option. However, when you have a binary event like an earnings event or some sort of major product announcement, something along those lines, or in the case of the indexes, a Fed announcement, that sort of news announcement, a binary event, can push that front period volatility to be much, much higher than the back period. And again, that's when we get into something called backwardation. So, how does this position make money? Well, first of all, let's just look at these two option strikes. If we look at the 23rd, let's do it here. If we look at the 23rd, well, I can sell that for $3,763. I mean, there's a spread here, but somewhere in that general range. and then I can come and buy the further dated exact same, in this case put, I can buy that for 41.35. The difference between those two is what I'm going to pay to get into this position, and that would be my max loss. Now, the two things that are tricky about calendars, it's very important to understand, is we have this tent. This tent looks nice and wide. This tent looks like if NVIDIA sold down to 600, that we would still have some profitability in here, is what it looks like. Or if we went all the way up to 820, that there's still a little bit of profitability that could be had up in 820. So in that scenario, it fully encompasses this massive range that I'm envisioning. Now, what's important to understand, though, is that is not truly the case, because what happens in these is when volatility comes out, that tent changes. In a butterfly, in a condor, in virtually any other trade you can model, the structure stays the same unless you have a time spread in there. That time spread means that this tent is something that's going to change. Now, our max loss isn't really going to change with this trade, with one exception, and I'll explain that in a moment. But the overall tent structure will change. So while I'm modeling this and it looks like I've got a range all the way down here to, break even all the way down here to 580 or somewhere in that range and all the way up to 840, that is not a real break even range. But it's kind of the best that I have. It's the best way I have to maybe look at this and decide kind of a reward to risk ratio. But I have to know and understand that is not going to maintain its integrity. And what I'll try to do is tomorrow morning on the open, I'll have this open and we can literally watch that shrink happen here. So all that said, I still am interested in this trade, and I'm interested in this trade because of this backwardation. And let me show you why the backwardation is important. So what happens here is in this front period, as soon as the earnings announcement is made, this volatility is going to shrink up considerably. Actually, both of these volatilities is going to shrink up considerably, but the front period is going to shrink up more. Now, we can just see our market literally just opened, and NVIDIA actually opened down at 678. So I will probably, I don't know. I could reconsider centering this, but I don't know. I think NVIDIA is maybe a little more likely to pop up. So I'm okay leaving my center up here. I'm not going to deal with that right at this moment. I'll just leave that where it is. But what I do want to show you is that here's what I'm looking to have happen. Again, right after the announcement, volatility is going to drop out on both of these, our front period and our back period. But what I'm hoping to have happen is volatility will drop more out of that front period than it does out of the back period. If that happens, that's where this profitability comes in quickly. So in other words, both of these are going to drop. I just need the short-dated one to drop more. And again, that's what I expect to happen. That would be a normal process. Now, if NVIDIA opens all the way up here at 8,900, there's not going to be much we can do about that. Or if it opens all the way down here at 500, there is a potential adjustment play that can be made. But when the difference between these two is only 1 week, it doesn't give you a lot of time for a potential adjustment. So the only way that I go into these trades is knowing that I could very easily be looking at the max loss. Now, the other important piece of this puzzle that's critical to understand when you're dealing with time spreads, this max loss is looking at the max loss on this Friday when this one expires, our short-term one expires. We can't leave this long one on at that point because this one then kind of has a life of its own, and it is a one-sided option trade. Let me just exclude this and you'll see what I mean. And all of a sudden, we have a lot more risk to the upside. We've got potential $4,600 in upside risk if we don't have this on with it. So this has to be traded as a pair, and it has to be traded. That's the only way it maintains its integrity. That means that unless I really know what I'm doing, I do not let this one expire, leaving this one intact. I need to make sure that I either close them both out at the same time, or as we're going into expiration this Friday, before it expires, I need to make sure that I get this one off. Again, unless I really know what I'm doing and I've got a plan for addressing that massive risk that would show up if I only have the one-sided option on. So that's calendars. Again, a little more of a tricky trade, but a good trade to paper trade and get an understanding of how they work. So with that, I'll see everyone later. I will try to monitor this tomorrow morning and show everyone what happens. Take care.